Hi and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture of my journey and development towards financial freedom. They will cover financial products and hopefully will also uncover financial well-being so you can reach your financial goals and aims. Remember, if you like the videos, smash the like button, subscribe to this channel so it can grow and reach a wider audience. Now let's get into this latest video. This video is about 5 essential investing tips for newbies or maybe seasoned investors to hopefully make your life simplifies and reach your investment objectives. If you're new to investing, probably the simplest thing you can do is to diversify. So invest in funds, ETFs, which are not risky, shall we say, or not as risky as individual shares. Now if we look at the following chart, quick overview of some of the funds your providers may offer you on your platform. Nice and simply, a quick overview. Now, it may well be you do some kind of risk profile to see where you fit in positions and then choose your appropriate funds based upon your attitude to risk. It may well be your provider offers you a selection of funds, my own platform provider does, to hopefully help and assist people who may want to choose their own funds. So if we look at the chart, shall we say, a cautious fund, risk profile about 3 out of 10, nice simple, reduced fees, around about 0.34%, relatively low risk across a number of sectors. As we get more adventurous, shall we say, we got a balanced fund, risk profile 5 out of 10, 0.3%, and then building up at the chart, risk process, a moderate adventurous fund, risk profile 6 out of 10, similar fees of 0.31%, and then an adventurous fund, 7 out of 10, 0.31%. Now it may well be invested across numerous sectors, so it could be an S&P fund, it could be a Nasdaq fund, it could include a technology fund, global emerging markets, China, FTSE 100, etc. So it will diversify across a number of funds and across lots of different stocks. So some stocks will do good, some stocks may not be great, but it will give you greater returns, nice and simply. Or it may well be you go for what we call diversification on a global scale, so a global equity fund. Risk process of 8 out of 10%, similar fees 0.23%. Now, past performance hopefully cannot be carried in the future, but you reckon the market returns around about 8% a year. Much better than what the banks and buildings can offer you, but simple funds. You will have good years, you will have bad years, but ideally an annual return of 8%. Now they reckon as you get more advanced, you could create what we call a lazy man's portfolio, with about 40% in individual shares, 40% in funds, 20% in bonds, so less riskier. And as you get older and older, your risk profile should diminish, and well, hopefully we get less from active funds, more into bonds, cash. So it will go like a roller coaster, but it will not give you sleepless nights. It will get less riskier, some kind of lifestyle as you get older. But that is all depends upon your own investment styles. A quick overview of my own style, shall we say. My ISA account, I'm putting in £1,000 a month. Annual returns, hopefully 10%. Last year we made 30% upwards, but a very good year for the market. But predominantly based in the UK, 60% in the UK, 24% in USA and Americas, 16% in Asia. So quite well diversified, but predominantly UK based, of which we hold 9 shares, 7 in the FTSE 100 makes up 36%, 2 in the FTSE 250 makes up 3%, and the remaining 61% is across 14 different funds. So across the S&P, emerging markets, China, small caps, technology, etc. But it's done because it's my own risk profile. But if you remember, if you're new, get yourself a tracker fund, get yourself ETF funds. Simple, diversified and relatively cheap. Now once you've got your fund set up on your platform, give some consideration to fees and charges. For my own platform, if I buy an individual share, it may charge me a fee of £9.99 each time I buy a share, whether it's £50, £100 or £1,000. and they will then add stamp duty on top as a percentage. If I buy on what we call a regular investment day, so my own provider says the 10th of each month, it will charge me a standard fee of £1.50. Again, whether it's £100 or £1,000, it's a set fee. So take advantage of offers on your platform. And again, with funds, I could buy funds on a regular basis, any set day, £1.50 per trade. But it may not be you buy £50, it may not be economical, it may well be you set up to a certain level. So it may well be once you've got £100 or £200, you then buy a fund of your choice to save on costs. So each time you make a trade, obviously be aware of the costs. Personally, I will buy and hold investments, okay? And I will also reinvest my dividends over a certain value. So any dividends I receive over £50, I will reinvest, and again, it will charge me a fee of £1.50, but it's not worthwhile doing it with very small dividends. It's just not cost effective. So give some consideration of fees and charges. And as we looked at the chart earlier, passive funds are relatively cheap, around about 0.3, 0.4%. If you're going to go into active managed funds, more expensive. So you may well be looking between 0.5 to 1% or even upwards. And a lot of active funds may not even beat the benchmarks, but give it some consideration of your fees and charges. One, for dealing, and also two, your platform providers may well charge you a monthly admin fee or a quarter admin fee to manage your respective accounts online. If you're going to make some kind of investments, make sure they're in a tax efficient wrapper, whether it's a pension, a self-invested pension, whether it's in an ISA, an individual ISA account. Just to cover ISA, shall we say, nice and simply, you've got an allowance of £20,000 per tax year from April to April. Now it may not be you use it, may well be you use only £1,000, £3,000, £5,000, but keep it in a tax efficient wrapper away from the government. It may not be an issue now, but it will be an issue potentially if your portfolio grows to a substantial level. And make sure all your dividends, shall we say, stay within the tax-free wrapper. You do have an annual dividends allowance of £2,000, but if you create dividends outside of the tax-free wrapper, at the moment it will be subject to dividend tax. If you're a UK base rate taxpayer, 7.5%. If you're a higher rate taxpayer, 32.5%. And you're an additional higher taxpayer, 38.1%. But those rates will be increased in April 2022 at the start of the new tax year. So it may well be you only get a few £100 a year dividends now, but what will your portfolio bring you in 5 years, in 10 years, when it's built some kind of momentum, and it may well be a sizable value. If we look at the FTSE 100, it's given a yield of about 3.5%. So ideally, if you had a portfolio of 57,000, you're going to be at the threshold of dividend tax. One of the shares I own, Legal & General, has a yield of 6.5%. So I would only need a holding of 31% before that threshold is broke. So it may not be consideration now, but it may be consideration in future. And also, keep it in a tax-free wrapper. Make sure you're not liable for capital gains tax. In the UK, you have an annual limit of £12,300. May well change in the future, but if you're above that threshold, it may well be subject to rates of 10% for a basic rate taxpayer or 20% for a higher taxpayer. So again, not an issue now when you're starting off, but it may be an issue later on in future years. So make advantage of tax-free wrappers. They're there, use them to your effect. As part of your investment journey, one thing you're going to do, obviously, or hopefully, is improve your knowledge. So it may well be watching YouTube channels. It may well be looking at podcasts. It may well be reading investment books, okay? Or looking at financial seminars, investments, shall we say. There's tons of information there on your platform provider. They will have useful guides. They may well do a regular weekly podcast. My provider certainly does. They may well be to do some kind of investment videos, okay, investment articles. So the information is there, use them. I personally listen to set videos or podcasts every week. Give me an insight into the market. It'll give me an insight into certain companies and what's happening in the market. but it's more generally for over how the financial markets are improving, and it's also to improve my financial education. And then as you get more advanced into your journey, shall we say, learn about different sectors, learn about different assets, diversify. Okay. It may well be at a later stage you do go away from funds, ETFs, and it may well you then buy individual companies which you're happy with, but do your research, use the tools. Okay, the information's there. There's tons of information. Use it to your advantage to improve your knowledge. One thing you should do also is track your progress. Now, not look at the markets every day or every hour. It will just drive you mad. It will drive you insane. There are good days, there are bad days, as we've found out for this year to date. But track your progress. It may well be record your values once a month. Okay? Is your portfolio making money? Is it losing money? Is it beating the benchmark? Is it reaching your retirement or investment goals? And then review your goals. Maybe it'll be every 6 months, every 12 months. Okay? Get some kind of chart. And as your investments increase in value, hopefully your attitudes will change, but it will also give you some kind of momentum. Now remember, it's not a get rich quick scheme. Okay? It will start off slow, but it will build some kind of avalanche, shall we say, or a snowball. It will build momentum over the coming months and years. And the final point to note, okay, is don't follow the herd. As we said, it's not a get rich quick scheme. Ignore the latest fads. You may make money in the short term, but not in the long term. A lot of times, people be on, shall we say, certain platforms promoting things, or it's on the news, it's on social media. But normally, by the time it's going global or viral, you're probably too late to the party. You've already missed the boat. Investing, quite simply, it should be boring. Think long term. Earn money while you sleep and learn the power of compounding. As we said, I'm a seasoned investor, shall we say, with millionaire status last year, but I've got a numerous portfolios. In my ISA account, it's 39% across shares. It will give me 10% growth. It will give me annual dividends, and 61% in funds. Again, all money raised and reinvested, but it's still done on a diversification, but it is done to my investment aims. We will have good years, we will have bad years, but think of it as boring, shall we say. Some of the companies I've got, quick overview: Lloyds, HSBC, Aviva, BP, Shell, as an example. Safe, secure companies, not going anywhere, very cash rich, paying dividends, but I do have some growth shares, shall we say, Card Factory, Greggs, JD Sports. Okay, so a quick back, but that's based upon my own personal suggestions. But don't follow the herd. Find your reasons why you're investing and make them personal to you. And as we said, the markets are giving a return of about 8% a year. It may not get you rich, but it will get you to your investment aims, whether it's in 5 years, 10 years, 15 years, which is the aim of the game, shall we say. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again in the next video.